Welcome to Vivid Box HQ. Beijing just slammed the door on capital flight, but it might be too late. In April 2026, China's money started running. On April 7, 2026, Beijing made a move that barely registered in Western headlines, but inside China, it changed everything. The government issued a new regulation on industrial and supply chain security. 6 days later, on April 13th, came a second rule, this one targeting what officials called impropers foreign reach. Both took effect the moment they were published. No warning, no comment period, done. On the surface, these read like trade tools, leverage for Xi Jinping before Donald Trump arrives in Beijing. And they are. But hidden inside the legal language is something much bigger. Tighter controls on money trying to leave the country. Cross-border capital suddenly squeezed. For a Chinese family with savings in the bank, this matters in a very real way. The yuan is weakening. Property values have collapsed. Your nest egg is shrinking, and the doors out of the country are quietly closing, all of them. The question that hangs over the next 8 minutes is simple. Why now? Why these rules, in this month, with this much urgency? The answer runs through underground banking networks, a Hong Kong stock exchange acting as an emergency exit, and a ghost from 2015 that still haunts every decision Xi makes about money. And we'll see exactly how Xi got cornered into making this move now. Those regulations did 3 things at once, and all 3 targeted backdoor channels Chinese savers have been using for years. The first is gray market stock trading, people buying foreign shares through cracks in the system that aren't quite legal but aren't quite policed either. The second is underground banking, informal networks, often run through Hong Kong and Macau, that move millions out of the mainland in suitcases of cash and untraceable transfers. The third is the cleverest. Invoice fraud. A Chinese company exports steel, but bills the foreign buyer for twice the real shipment value. The extra cash gets parked overseas, far from Beijing's reach. China Customs has been tracking this for years. Their best estimate is striking. Around 20% of all Chinese steel exports in 2024 were illicit shipments, dodging both tax and capital controls. That is not a rounding error. That is billions of dollars leaving China every month, hidden inside ordinary trade paperwork. The Ministry of Commerce announced a new licensing system for steel exports in December 2025, set to start this year, designed specifically to shut that pipe. These are the holes Beijing is now plugging. All at once, gray market shares, underground cash, fraudulent invoices. Every escape route the middle class quietly relied on, sealed in the same month. So why is XI moving now? What changed in 2026 that made the pressure unbearable? The numbers tell you why. On April 14, 2026, the onshore yuan sat at 6.82 against the US dollar. That is stronger than the market wants it, meaning the People's Bank of China is actively defending it against pressure to fall. The dollar is strong worldwide. Every other major currency is sliding. Beijing is fighting that current with both hands. At the same time, the property market, where ordinary Chinese families parked roughly 70% of their household wealth for 2 decades, has collapsed. Construction sites sit silent. Apartment towers that were supposed to be inheritance for the next generation are worth a fraction of what families paid. The middle class watches its net worth evaporate year after year. Put yourself in that household for a moment. Your home value is falling. The currency in your bank account is weakening. The stock market in Shanghai has gone sideways for years. You would move that money the second you could, anywhere but here. That is the convergence that forced Xi's hand. A falling yuan, a frozen property market. A middle class searching for any place, any account, any asset, anywhere that still holds its value. Analysts warn this is the kind of pressure that cracks capital controls, not just regulations on paper. And until April 2026, those households had a perfectly legal escape route, one Beijing itself had built. Look at the bars. In 2022, mainland Chinese buying Hong Kong stocks made up 24% of the Hong Kong market's turnover. By 2025, that number had jumped to 38%. Stock Connect, a system Beijing originally designed to let foreign money in, became the biggest legal pipe for Chinese money to get out. The system flipped, and Beijing watched, alarmed, because they had seen this movie before. In 2015, the trauma that built modern Chinese capital policy. Beijing loosened its capital controls that year, and money started racing for the exits within months. By the end of 2016, the central bank had burned through roughly $1 trillion in foreign exchange reserves trying to defend the yuan. That is not a typo. $1 trillion. Enough to buy every NFL team, every NBA team, every Major League Baseball team, and still have hundreds of billions left over. For Equus, for XI personally, this was a near-death experience for the Chinese economy. The People's Bank of China was forced to fight a losing war against its own citizens trying to move money out. The reserves stockpile Beijing had spent decades building, its insurance policy against a hostile world drained by hundreds of billions in months. The lesson burned into Beijing's policy mind from that moment was simple: stability before openness. Every step toward letting money flow freely after 2016 came wrapped in safeguards, daily quotas on Stock Connect, circuit breakers ready to suspend trades the moment volatility spiked, restrictions on reinvesting offshore capital back into the mainland. So when she looks at 2026, at a weak yuan, a broken property market, southbound flows surging, he does not see a financial story. He sees 2015 happening again. And this time, the world outside is far less friendly to China than it was a decade ago. Which brings us to the strangest signal flashing in the market right now. There are two yuans. The onshore yuan, traded in Shanghai, controlled by the PBOC's daily fixing rate, and the offshore yuan, called CNH, traded mostly in Hong Kong, where global speculators can bet freely on where the currency is really heading. In a calm market, these two prices stay close. In April 2026, they are pulling apart. The PBOC has been setting its onshore fix stronger than market logic suggests it should, defending a level the rest of the world does not believe in. Meanwhile, offshore traders in Hong Kong are pricing the yuan lower, betting Beijing will not be able to hold the line forever. That gap between the two prices is the market screaming a warning. Speculators have placed their bets, and they are betting against C. This is not theoretical. When offshore divergence widened in 2015, it dragged the onshore rate down with it. The PBOC had to spend reserves to close the gap. Every dollar Beijing burns, now defending 6.82, is a dollar it cannot deploy when the real crisis hits. And the central bank is trapped between three impossible jobs at once. Exporters want a weaker yuan to stay competitive against global rivals. Energy importers need a stronger yuan to keep oil and gas import bills manageable. Households watching their wealth evaporate need absolute, unshakable stability. The PBOC can deliver any two, never all three at the same time, which is why the April crackdown looks less like strength and more like a country running out of options. Xi Jinping is now facing the cruelest kind of trap. The capital controls he just tightened are supposed to prevent a slowdown by stopping the money drain, defending the yuan, protecting reserves. But here is the catch. Those same controls signal to every Chinese household and every foreign investor that things are bad enough to require emergency measures. Confidence collapses. Spending freezes. Foreign direct investment, already at a low of just $80 billion in 2025, keeps falling. The recession the controls were meant to prevent becomes the recession the controls helped cause. The data we reviewed projects only a slow recovery in foreign investment through 2030. The yuan, on current trends, is expected to settle around 6.9 per dollar in 2026, meaning Beijing is fighting a current. The analysts themselves expect to keep pushing against it for years. Step back and look at what just unfolded. April 7th, the supply chain rule. April 13th, the extraterritorial rule. New steel licensing, tighter customs. Every gray market and underground channel squeezed in the same month. The 2015 ghost demanded it. The yuan pressure, the property collapse, the southbound surge, all of it forced Xi's hand at once. This was never really about Trump's visit, or trade leverage, or industrial security. It was about a leader who watched $1 trillion vanish a decade ago and swore it would never happen on his watch again. The trend the numbers expose is harsh. Capital controls do not stop the flight. They just hide it for longer. Whether Xi can hold the line until the next downturn, or whether the line breaks first, is the question the world is now waiting to answer. If you think capital controls can actually stop capital flight, hit like and share this with someone who needs to understand China's financial trap. Subscribe to see tomorrow's breakdown. See you tomorrow.